I want to kick off very quickly with an introduction of our three panelists. Jake, I think you already know. These guys have basically put this event on with Alex, who's somewhere from our team over there. So thanks, Alex. I'm going to very quickly kind of do the introductions for you guys, if that's all right. Max is an exceptional guy and friend at Fabric Ventures, who are, I think, one of the best VC funds in Europe. They've been doing some very interesting stuff as a VC in terms of thinking about participating in networks and viewing that from a VC angle where you have a 10-year lockup on a fund is very different to what CoinFund is doing and what Multicoin is doing. So really looking forward to having these kind of different viewpoints in terms of what you actually do in terms of the boots on the ground type participation in networks. And Kyle kind of needs no introduction. Kyle I met a year ago and has executed like nothing I've ever seen since then. He's a household name now in crypto, runs Multicoin, which is a wonderful fund out of Austin, Texas. What I'd love to do to start is for you guys, Jake, to define what generalized mining actually is for you two, and if that differs from the great presentation Jake was giving.
I'm happy to go first. So the way we look at generalized mining is the idea that well, we also call it sort of active network participation, and that might differ in the definition a bit later on. The way we look at it is that if you look at sort of Airbnb or Uber, there's a whole bunch of work providers within those networks that generate a whole bunch of value, and they don't necessarily get any value of the sort of network effects that come out of that. And so if you look at a lot of these decentralized data networks that we're investing in, whether that's sort of Dharma with debt providers, whether that's Ocean with data providers, or Masari with curators, there's a lot of people and a lot of actors, whether that's machines or people, who are providing a lot of work into these networks. And so generalized mining or active network participation is the process of understanding how you can incentivize those people to continue providing good work to these networks. And generally they get paid out in some shape or form, whether that's tokens or direct cash flows. And that's sort of the idea that we see as this active participation within networks, and that's our role as investors as well when we invest in the long term into these networks.
Yeah, I think I'll echo what Max said. I kind of like the term just generally active network participation. To me, mining just kind of espouses like a visualization of like data centers in China with like big server farms, and we don't do any of that. In general, there's like tons of kinds of opportunities. So we're seeing stuff like arbitrage over there on things like Maker and maintaining the Maker peg. We're seeing opportunities around like just converting assets. Again, like in the case of Maker, lending assets on something like Compound, transcoding in LivePeer, running layer 2 networks and scale. So I mean, all of these, like, they're operationally different. Some of them require more technical know-how. Some of them require putting up capital. Some of them require taking on a little bit of financial risk in different capacities. But like, there's all these ways you can help bootstrap these networks. And I think the general idea, right, is that we all know bootstrapping a network is really hard. But if the network works as advertised, then value typically compounds and grows exponentially because of network effects. And so as an investor, the way we think about it is like maximize probability of success, because in the event of success, you get asymmetric outcomes.
So it would be great to start diving in by getting you guys to sort of define the bounds of generalized mining specifically to what's appropriate for kind of your funds in terms of what you would do. So we have all of these different, firstly, I think, kind of separation out between securing the network and actually providing the raw work to the network, which is not always the same thing. And then the second is, we have a massive amount of different types of work that can be provided. And the straw man that I've used before with you is kind of decentralized arbitration networks. So there's one called Kleros. Kleros is basically the idea that you can arbitrate a dispute, for example, over like a paper contract out to over a decentralized network to arbitrators. And so what you have there is basically like a bunch of lawyers sitting in a room providing work to the network, but that work is very much kind of happening in a human mind. It's not software, it's not machine driven. And so it would be great if you guys could talk a little bit to maybe Jake, like 3 things that is work provided for a network that does not fit into generalized mining. And then from Max and Kyle, maybe one after the other, just like 3 examples of stuff that you guys are maybe thinking about.
Sure. So the question is, what kind of opportunities are not generalized mining? In other words, well, I think if a network is implementing a marketplace, and on the other side of the marketplace are customers, and you're a fund, I don't think it's that interesting to be like a cold provider, like to get revenue from sort of the product. I sort of see the role of the fund, being more on the network or protocol level, and not so much like interacting with revenue, maybe is a way to put it. How's that?
Yeah. So like file storage, for example, would be in scope.
No. Okay. So in terms of like the profile of the opportunity, like I guess, like Kyle pointed out, like I don't think funds want to be running data centers, and so there are companies that are very specialized for that. But I think funds shine more on the side of the spectrum that has kind of proprietary software algorithms. And if you look at the set of generalized mining opportunities that are software intensive as kind of a generalization of quantitative trading, right? So if in quantitative trading you have quants who are coming up with algorithms that are proprietary and generate alpha, and they're putting orders into stock markets or other kinds of markets, then here you are creating proprietary algorithms that are putting transactions maybe into networks. And sort of a nice byproduct of that is that you're adding value to the networks, whereas if you're a traditional quant, you're just kind of maybe making money.
But do sort of these to Kyle's point, like maintaining the peg, which is basically like taking advantage of arbitrage opportunities, for example, in Maker, does that fit into the quant bucket? And if so, is the quant bucket part of this generalized mining bucket? And yeah, I know with a VC it's very different, but
I think so, right? Because if you look at things like, Augur prediction market settlement, that might be a market-making algorithm, right? It might be a proprietary algorithm, but that makes sense from an investor point of view because by adding that service to the network, you're making the network more usable. It's likely going to attract more customers, and if you're an investor in that network, then you have a long-term view and you're aligned with that view.
And how kind of binary is this work? If we think of kind of traditional proof of work, everyone is basically in Bitcoin buying the same chips because the nature of chip manufacturing is that it's centralized. And so you buy the chips and you just kind of apply electricity and you're either mining or you're not. And so what I'm curious about is to hear from you guys, from the examples that you guys have done work on and studied, how binary or non-binary is the work? How much does the quality of your software actually matter?
So I think that's actually a really interesting question because it will bring up the point of specialization within these generalized mining opportunities. From our perspective as a long-term venture investor, our job is to look at opportunities and understand disclosures of what networks are doing, and so to help in the governance and the curation of something like Messari makes a lot of sense. Equally, we are scouring GitHub for data in terms of contribution from different developers to different networks. If that's something that we can bring into the Ocean network as a data provider while running nodes there, that makes a lot of sense. Whereas what I still consider to be generalized mining, for example, providing debt on Dharma, is not necessarily something that is neither in our expertise nor in what we're intending to do with the cash that we have, because that's not an investment. And so generally, the way we think about it is that if we make an investment into a network, the majority of the benefit or the value out of this generalized mining will come from the fact that that value will increase in value due to our work. If we increase the number of, let's say, tokens we hold out of that, that's just a bonus, but that's not the core reason to do it from our perspective.
So one thing on market making specifically, this is something that we think is probably the single biggest thing we can do as an investor for our portfolio companies. And unfortunately, we can't do it because we're not a registered broker-dealer. It's like a very high requirement as a fund to do that. There are a handful of funds out there that today are, but it's just generally pretty difficult. But something we're like thinking about how do we get there. I think two very non-intuitive forms of work that don't get enough coverage today are in two networks that we are actually pretty active in. One is EOS and one is Factum, and both of these networks are very human-heavy, squishy networks, and pretty non-objective in a lot of ways. EOS, is, for example, is by design political. Miles, who's on our team, is running a block producer, and although I'm not like operational, I sit on the board of Aurora, and so we understand kind of what Miles is doing, and we understand the kind of like navigating that ecosystem. So a lot of the work in that network is actually like explicitly political, and it's by design. So it's navigating relationships, navigating people, understanding, how do you bridge, like the big challenge in EOS today, and this is also true in Bitcoin and Ethereum as well, although less pronounced, is just the Asia-US divide. It's just like the culture, language, everything is just like, there's a rift. And so like Miles is learning Mandarin right now and trying to figure out like how do we seriously, like he studies 1 hour a day and trying to figure out like how to bridge that divide. And so like that's a lot of the work that kind of goes into that network that's very EOS specific. The other one, and this one's very under the radar, is Factom. Factom is explicitly actually a permission network. It's permissioned in a lot of interesting ways. And in Factom, it's extremely cohesive. It's a very small number of validators, all selected by humans. And these humans are all motivated to improve the network in various ways. They're all paid by the protocol through inflation. And in this network, like they're rolling out a couple of very interesting token standards, really focused on tokenized securities. One thing the Factom team realized, for example, is that if you're doing any form of tokenized security, like securities are by definition a legal construct. They live within the confines of government. And so like putting a legal construct on a permissionless blockchain is like kind of backwards. Like it's totally unnecessary. And so like Factom is a permission chain with orders of magnitude performance improvements over permissionless chains. And so Factom is this idea of like, hey, let's try and get some tokenized securities on here. I don't know if it's going to work or not, but it's an interesting idea, and the team the block producers are pioneering it in this case. My point, kind of coming back to the original question, is like what work do you do? So we're helping the Factom team like find some early customers. In the case of EOS, we're like helping trying to bridge this Asia-US divide, and like these are all like very human squishy problems. It's all like behind the scenes, no one really sees it, but like it's definitely a major part of being a network participant.
I think about the live peer Merkle mine. The live peer Merkle mine is essentially a decentralized airdrop where the protocol is incentivizing third-party miners to airdrop 63% of the live peer token supply to 2.6 or so million Ethereum addresses. And to my knowledge, it's like the first kind of experiment like that of its kind. And so, when you're engaging that kind of opportunity, it is very much a proprietary software kind of opportunity in two parts. So one part is kind of computation of the Merkle proofs that are required for redemption. And the other part is the optimization of transaction submissions into the network, which is a common but non-trivial problem as you have fluctuating gas, problems with network congestion and all these kinds of things. Now, if other networks look to that model and adopt that model, I think over the long term, that becomes very much a sort of commodity activity. And then I also think that in other networks or situations, you might start out with a commodity activity like staking, and then over time, sort of realize that making generalized mining returns in that network is a proprietary activity, or that's the way that you generate those returns. So I think it kind of transitions each way.
So I'm really curious, like, how much of this stuff is kind of on the horizon versus actually actionable today? If we were to write you like a $20 million check tomorrow, like you take the money, how much of that does actually get deployed into generalized mining? Is this a kind of thing that would work in that scenario? Or is generalized mining sort of a very much kind of side activity that's helping you, for example, get access to deals?
So I think in every one of the areas, I believe there were 6 or so that I had in my slides, I think there are example networks today where you can do those activities. I don't think it's a large, like in the hundreds, kind of space today, but all of these networks are sort of racing to production to provide those kinds of activities. But today you can curate content, you can earn money, you can provide space, you can earn money, you can provide computation, you could play around with crypto economic mechanisms like FOMO 3D. You can certainly be a validator on many, many different networks, proof of work and proof of stake, and so on and so forth. So I think this is a very early stage of a growing space.
Yeah, and in that sense, coming back to the point I made earlier about the fact that we only would participate in such networks if we are invested in those networks, at least in an initial case. Generally, we look for networks that have gone live, which in the case of our investments have not necessarily happened yet. But we are, however, by the relationship that we have with the team, is able to, for example, run nodes and validators on testnets. So as an example would be with the Ocean Protocol, where we've worked closely with the team to work on their local testnet and create an abstraction of their marketplace, where we have created 2 bots that trade data amongst each other just to understand how the economics work behind that. So while that's not necessarily live on mainnet yet, it's something that we have been working with them on testnet, for example. And over time, we'll be waiting for a lot of these networks that we've invested in to actually go live, where this could easily be swapped onto mainnet as well.
Yeah, I don't think you can deploy too much money today into like explicitly kind of generalized mining. I think for us, like today, right on $70 million, $75 million, it's like 1%-ish, right? So like call it $1 million or $2 million bucks. So not very much. But I think that's the wrong way to think about the problem. I think the best example of this is like LivePeer is like for us, the only thing that matters is LivePeer succeeding. Like if I get more return, get some more LivePeer tokens, like that's great. But like my only priority is for LivePeer to succeed. Because like that 10x or 100x is worth more than like an 8% or 12% yield. Like I just don't care. I mean, I'll take the tokens, but I just don't care. And so when we think about like generalized mining, right, for us is like the only goal on asymmetric outcomes is maximize probability of success. And so like LivePeer, like LivePeer architecturally is one of the beautiful things about it is that it's one of the few technical services that is actually better decentralized than centralized, because you want the transcoders to be regionally distributed. You want them to be close to the source of the video stream. And so, right, for us, the ability to, like, as LivePeer team starts selling this thing to all these bespoke people who stream video, like the Flow Sports of the world, and like whether it's Twitch or people who like would stream on Twitch, whatever, I don't know like who the people are, but as they start like selling this stuff actively to the world, like those people are concerned about price and they're concerned about performance. Like those are the two only things that matter. And so for our perspective, like anything we can do to make sure the price is as low as possible and the performance is as good as possible, like that's like how I deliver asymmetric outcomes. Because once the flywheel gets going, then it can compound. And so like, you know, the amount of capital I can deploy into LivePeer transcoding, I don't know. I don't think it's very much. It's probably a rounding error on the fund, but like the impact it can have on the fund is meaningful.
So it sounds like, you know, we've had some ideas of how you actually come to generalized mining. I think this idea of bootstrapping the network, and for me, this is one of my favorite things about generalized mining. It's sort of the first time that you hear a kind of coherent idea around how we're going to bootstrap network adoption, which is basically like we're going to have funds that provide the supply side, or companies that provide the supply side of the equation for this thing to actually be running. But so we have kind of like this idea of bootstrapping the network and this asymmetric return, which is kind of a VC mindset. You could also look at it as a kind of return stream for the fund. But it sounds like for Kyle, at least, you can't really deploy that much capital to it. The third, I guess, would be just like reducing the cost basis of your investment. Yeah, Jake, do you want to talk to that?
Yeah, so if you think of some of these opportunities as a mechanism of entering a decentralized network in a particular stage of its life cycle, you know, I think it's possible then to use technology to do that, and you know, case by case, and depending on what the network is, like you might actually be able to kind of like lower cost basis or get tokens for free, maybe even in some cases. So in the case of LivePeer, you know, we at CoinFund, we put out a pretty intense kind of economics breakdown. Where we sort of calculate that, you know, because miners have substantial access to the liquid token supply, and sort of early investors are vesting and can only bond sort of the vested portion of their supply, you know, there's a case to say that like maybe miners can actually get comparable stakes in the network, and I think you see some of that.
I think coming back to your point about bootstrapping the networks, for me that's almost the most important point as to why would one do this. So if you consider a network like Keep Network, which is one of our investments that we've made, you're quite sort of flipping the question around about what would you do with $20 million right now into what happens if $20 million is invested into Keep Network, those investors lock their tokens up and nobody actually uses them. Given that it's sort of a taxi medallion type model, what happens if you have a city in New York City and there's almost nobody driving a taxi because they're all storing it for an investment? So it's important for these investors that actually buy these tokens to then, as a side effect, just like any traditional VC would have sort of value-added services, sort of the best example, I guess, being Andreessen Horowitz and a 150 people team that they have to deploy to their startups to actually deploy these services and run keeps, secure these keeps within the Keep network. Equally, if you think about something like Foam, where it's actually a lot more distributed rather than focused on a couple of sort of providers, they made a very clear point that the investors in Foam were to actually run these beacons that are distributed across a geographic location to effectively seed that ecosystem so that when the first user comes onto the network, there's actually some sort of utility. And that to me is actually the real definition of a utility token, not sort of a means of payment token. And that's where we see this idea of seeding the network. As mentioned, sort of reducing your cost basis is great, but that's not the core reason for us to do this.
Cool. It would be questions? Yeah.
Hypothetically speaking, right? Imagine you've got $500,000 and you want to invest. So how would you define where to invest? Like, what kind of investment would you do? What would you do with this $500,000?
I think this question is probably more focused towards the two of you, given that you might actually go into investing it directly into sort of the mining or generalized mining process on our end.
And we want to invest in cash, bitcoins, or equity. You have to choose how we put the money.
We'll take the cash. And then we probably invested into a network that has let's say, a work token. The large majority of that, and as part of our sort of services that we would add into the investments we make, we would actually use that work token as a work provider within that network to seed that ecosystem. That's sort of the position we take in very short. But I think the question is probably more targeted towards the two of you.
Sure, I can take that. So I think in our context of how we think about it, so one thing to say is, I think today, right, if you look at, let's say, staking networks, right, and you're getting kind of a 5 to 20% token denominated return, but then you have massive fiat denominated volatility, it's probably fair to say that like most people are staking on Cosmos or Tezos today because they're expecting like a large outsized fiat denominated return. They're expecting those networks to grow. So that's to the point that like, okay, you're staking, you're kind of maximizing your tokens, but really you're making an investment decision in that network. And so like in our world today, you would build that portfolio probably on the same principles that you use to determine like what kind of companies and projects and networks you invest in today. Now, I think sort of in the long term, you probably will see that there's less fiat denominated volatility when there's like less growth. And then it becomes more of a portfolio optimization problem where you have, okay, so mining is a sort of safe but low return activity. I mean, like proof of work mining, and then staking is maybe the same. And then you have on the other side kind of like a high risk, early stage life cycle. I'm mining to bootstrap a network kind of activity, and don't know that token's ever actually even going to get liquid. And maybe that's like a high risk, high return activity, and then it becomes a portfolio optimization problem, right? Like maybe you can use.
So at what level I can invest with you? At which level?
I don't know.
I think an interesting hypothesis to take there is if you purely want to invest into the generalized mining aspect of that, you can consider that if you think about these general networks, whatever you assume that sort of general yields to be across these, at some point in time, in probably let's assume the next year, you'll have a service, whether it's DYDX or something like Vega Protocol, to take a derivative on the underlying asset to sort of swap out or hedge against that sort of volatility risk of the underlying asset. You can also do something like CDX, actually take an insurance against one of the service providers that you're staking with, and hence that returns you actually a sort of risk-free rate of interest of that digital economy. And that would be what you could consider to be a pure investment into the generalized mining without any sort of bet onto the larger sort of volatility or investment perspective of that underlying asset.
I know volume is obviously a huge issue when it comes to investing, especially on the scale that you guys are contemplating and thinking about. I guess just as a whole, if you guys could speak a little bit about that and how that influences your guys' decisions in terms of seeding a network, as well as deciding on when to jump in and when to jump out, and if you will jump out long term or stay in short term. I guess just kind of talk a bit about that and your thoughts on that.
It's a really good point. I think as we had a panel with sort of service providers just before, it seemed like a lot of the work was going into Ethereum, Cosmos, Tezos. And that makes sense. Those are the large networks today. As sort of seed stage venture capital investors, we will often invest into networks that might have much lower valuations, where it doesn't make sense to actually set up a external service provider to actually stake within those networks. And so there might be a sort of 6 month period where there's that gap, and that's that gap that we intend to fix by jumping in, staking within those networks, validating transactions, whatever, and it ends up being sort of the idea of generalized mining in that context. And as soon as that network becomes big enough and actually profitable enough for some of these service providers, then we might potentially jump out. And as venture investors with sort of the long-term view of actually just really trying to increase the value of the network itself, we could potentially run at a negative or at sort of a loss in, as you mentioned in your sort of blog post as well, venture investors have the ability to run at a loss over that initial period. And sort of that's also a period when there might be a lot less volume, and so there's a lot less interest from external service providers.
I think generally when we make investments in early stage stuff, we're committing on a minimum multi-year time horizon. You just, even if you wanted to get out, like today, it's not really practical. I mean, if you look at Tezos, right? Like the nominal valuation is $1 billion or $2 billion or something. I mean, it's a pretty real number, but volumes today are still pretty low. So if you have a meaningful Tezos position, like you can't get out today. So, using that as an example and just project forward, right? Like I think it's a reasonable view that most networks, if you're investing at the earliest stages, like you're committed for a few years at a minimum. If you look at the late stage liquid stuff, then like that's a pretty objective, like easy way to look at liquidity. But yeah, I mean, I can say like on a time adjusted basis, it doesn't make sense to do work in a network unless you believe in the network. Like spending literally more than one mental cycle on anything, if like it's not worth it unless you actually have long-term conviction in the asset.
Yeah, I mean, I think I think definitely there's a long-term view in this kind of investing, and like I mentioned, these are really investment decisions today. So I think volumes grow over time, and in like a success scenario, you probably have enough volume. Like speaking for us, like we don't do a huge amount of like high frequency or very active liquid market trading, so it's less of an issue for us.
So you guys had some interesting points to make about labor-intensive active participation. Would it be fair to summarize your opinion to say that if the active participation is providing private goods, like arbitrating legal contracts in Kleros, then that doesn't really make a lot of sense for a crypto fund? But if it's providing public goods, like bridging the US-China divide in EOS, then that makes more sense?
I would generally agree with that.
Yeah, I'd agree as well. I think there might be some exceptions if you are, as mentioned before, I don't know, if you're a risk specialized fund, it might make sense to provide work on Maker, for example, to close CDPs. Or if you are a data provider that might have invested into Ocean, it might make sense to provide data into the Ocean marketplace. But those are sort of some very specific examples of private goods that might make sense to add to these networks.
That's an interesting way to phrase it. When he first spoke about Kleros, I was thinking it didn't make sense for us to do it because we're not lawyers, and so we're not really qualified. I hadn't thought about generalizing to kind of the broad public-private thing. My immediate intuition is that's like the right way to draw the line, but I need to think about it more.
Many of the kind of either like the active market or active network participation that a fund might do early to kind of bootstrap a certain network involves a higher degree of smart contract risk than simply keeping things in cold wallets. To what extent are you, either in your participations already or in the kind of notional participations in the future, would you want insurance for those kinds of things, like the kind of increased risk associated with having funds in different kinds of smart contracts or keys exposed in different ways?
Yeah, thus far for anything we're doing, we're not putting any real our private keys at risk in a meaningful way. I think today we don't have a solution that like, we'd have some risk threshold in the fund, right? Maybe it's 20 basis points, maybe it's 50 basis points, maybe it's 100 basis points. I don't know what that risk threshold is, but we could say, hey, look, even if it goes to zero, like we don't care. And so, I think that's one way to think about it. Now, if we had something where our conviction is super high and we wanted to put in 500 basis points or 1,000 basis points, we would like need to figure out what to do there. That hasn't come up yet, so I don't have a good sense for it. I generally, while I think the idea of insurance for smart contract risk is like, it's a novel, it's a good idea in theory, I think in practice it's not going to work in the way that most people want. I think it's kind of two fundamental problems. One is most humans don't process tail risk. Like my job is to generally think about tail risk, and like there's a real probability I'm going to screw it up and like not like catch some form of tail risk that's going to screw me. And like humans generally are pretty bad at this. If you look at the largest insurance markets out there, they're all legally mandated. Health insurance, car insurance, home insurance. Like humans generally don't buy forms of insurance that they aren't legally mandated because like they feel stupid paying for something that has tail risk. Now you can say, well, you're a fund, and so like your job is to think about tail risk, so you should buy insurance. But I'm not sure that market is large enough to matter. I'm also not sure that like 3 years from now this will be a serious problem. I think we'll have the like software tooling within a few years that this gets managed. I also think for insurers, pricing this risk is like damn near impossible. And like when it's damn near impossible, that just means the rates go up. So like, for example, we looked at insurance for just custodying our own assets, and it was like, I think for $1 million of coverage, it was a $40,000 deductible and $40,000 premium and a $250,000 deductible. So we were paying $40,000 for $750,000 of coverage. Like it's just offensive. Like it's actually irresponsible as a GP to pay that to our LPs. And so like, it just doesn't matter. So there's just like a lot of like structural friction in the market. I'm not convinced it's going to work in practice. I like the theory. I like, don't think it's going to work.
I think from our perspective, we are in the business of taking risk. If you translate venture capital into French, it's capital risque, literally. And so our returns in general in the industry come from a power law distribution where the sort of 2-3 outlier returns in a 30 odd portfolio distribution actually return the majority of the fund. And so we see that as part of the risk that we would take on while participating in these networks. And actually, the sort of outline in an investor's mind is often that actually there is absolutely a risk of complete failure. It is early stage investing, and that's part of it.
It's an interesting question for, let's say, custodians, right? And maybe by extension, crypto funds and other entities that are using custodians. So if custodians want to participate in these sorts of opportunities, you're right. It might turn out that they're actually not custodying those tokens at all. Those tokens are being custodied in the smart contract of a staking network or whatever it might be. Now, I know that there's definitely a decentralized insurance space in blockchain. There's a bunch of projects kind of thinking about crypto native use cases for insurance, and hacking risk and those kinds of various kinds of smart contract risk are on the table to get some kind of decentralized insurance product. It's an interesting question whether that is a great business or a huge market, especially in light of the fact that you have formally verifiable smart contract languages and things like that significantly reduce those risks. So I think it just remains to be seen how well those solutions work and what is the incidence of those risks.
I've got one, and then we'll take a last question if that's all right. Just this is sort of a quick one, but crypto, if we rewind, was meant to reduce the cost of trust. And as we move towards some of these new consensus mechanisms and staking, what we're seeing is potentially an enormous amount of capital actually getting locked up in order to secure networks and provide trust in the network. And so, we've just had a panel on staking, and this is a little bit different from generalized mining, but how big do you guys feel that the staking opportunity is going to be? How much capital do you think is actually going to be securing networks, and what will be the ratio between that capital and the value that the network is providing?
My view is I think that kind of the consensus layer has to go probably away from proof of work and into sort of more efficient consensus, and that seems to be the promising area there seems to be like formally verified proof of stake algorithms. Most of the networks that come onto the market today are probably not proof of work networks. And so that makes me think that there's going to be a proliferation of these kinds of networks, and so there's going to be a proliferation of opportunities.
And as these networks also become more mainstream, there'll be less and less friction inducing ways to actually stake within these networks. So if we consider sort of the very earliest stages, it might be a few early investors that decide to stake within the networks to provide utility to the networks. After that, you might have sort of service providers that actually provide a very easy-to-use service for people to stake within these networks, and that might increase the security as well. And over time, you might actually think that custodians will probably come out and also stake within these networks. There's no reason for Coinbase not to do that staking themselves on some of the assets they hold. And at that point, there's actually a good chance that there's a very high percentage of these assets that are locked up within staking.
Yeah, I think there's actually a reasonably easy way to answer the question at like a top-down basis, right? Like all networks security and all networks proof of work and proof of stake is a function of market cap and inflation, right? So Bitcoin today is called at 150 billion, and like I think inflation is 4% right now. So like network security is 6 billion plus or minus, and like right, that means rational miners will spend up to $6 billion securing the network. Like in general, if you look across these networks on a long-term time horizon, my suspicion is inflation is going to like level out at somewhere between 50 and 150 basis points. Just as a sense of comps, like gold has been inflating at about 150 basis points per year for the last 30 or 40 or 50 years. And like we don't actually know how much gold there is in the planet. People just kind of keep digging it out like somewhere. But it's like 150 basis points. I'm actually pretty sure in crypto networks you can go lower than that. Just thinking about like market caps and like EOS today is like 6 billion and it's 1%. So there's $60 million of revenue flowing in the EOS block producers right now. As like one comp, and I think as you scale these networks out to hundreds of billions or trillions, 1%-ish is like the right kind of number, maybe less. So like, market cap of crypto divided by 100 is probably the right ballpark.
Sure, just last question. A lot of the conversation has been around activist money assumption being good. I would love to hear about activist money assuming sort of bad behavior, kind of like shorting projects that you guys might not like personally or from a investment philosophy, and just what is that time horizon and what is that domain expertise for? Maybe does that get bifurcated for like early stage? That's more quote unquote good money, and does that change over time for networks that mature?
Yeah, we've actually thought about this a lot, and actually I think I have a pretty good contrarian answer on this one. So the best empirical data point for this is the CVE bug in Bitcoin that was discovered like a month ago, where like miners could have introduced inflation beyond the 21 million, the scheduled inflation rate. And the bug was there for like 18 months or something, and it was there for a long time. And it turns out not a single miner took advantage of this bug over that time period. And so like my biggest takeaway from that is that like if you aren't, no one took advantage of this. And like if you're a miner, maybe let's say there was a miner that knew this bug existed and they could have generated like, I don't know, 1 or 2% like extra inflation that was not otherwise supposed to be there. And literally none of them chose to do it. And the biggest takeaway from that is that like those miners they were either ignorant, or if they knew about it, they thought it was actually not in their best interest to take advantage of that, which means they were so concerned that if they took advantage of this bug, people would freak out, the price of Bitcoin would crash and their mining hardware would be worthless. And like my big takeaway from that, looking at like literally the single largest network in crypto, is that actually like attacking these networks, like unless your goal is pure sabotage, like it has to be a state level actor who does not have economic motivations. I think, at some level of scale, maybe it's 10 billion, maybe it's 50 billion, maybe it's 100 billion. I think it's somewhere in that kind of order of magnitude. I'm pretty sure it becomes impossible to attack these networks economically unless your like objective is pure sabotage. And we now have like Bitcoin being the best empirical data of this. That like it just becomes too hard to do so. Proof of stake systems are like I'm generally of the opinion that proof of stake systems will like be objectively superior to proof of work systems for security. The one thing that is still unclear is like if you can get $1 billion of short interest like out of band, like can you use that to attack a network? That's still unclear. You can't really like go short mining hardware, and there's no like practical way to do that, at least not at any level of scale. I think 3 years from now, you will probably be able to put on $1 billion ether short if you choose to. And like, that's the only like, I think real risk to proof of stake systems. But like so far we have evidence that unless you're like outright like state level sovereign attacker, it like doesn't work.
But I think that example only talks about sort of a one-sided argument where the Bitcoin miners obviously have a lot at stake with the ASICs that they've bought. And so running through a theoretical example, and I haven't actually thought this through economically, but just bear with me, in the sense that if you are heavily invested in another network that is competing with a network that you could potentially attack, so for the example of EOS and Ethereum, recently there was a bridge that was announced that you could easily port any ERC20 token over to EOS. Would it be in someone who holds a lot of EOS tokens' interest to actually try to attack Ethereum in an activist manner? I don't know if the economics work out. We obviously love all the projects we invest in, and we would never be a malicious activist attacker within them. But it is a question that I don't know if there is actually a clear answer that it wouldn't make economic sense to do that.
Cool. We're gonna.
Can we maybe just take quickly one more?
Hi, thanks for making time. I'm just wondering how you're going to support networks with very active work tokens, such as Augur, which require individuals to take specific actions to earn rewards.
Yeah, so I think so we're not invested in Augur, so we haven't spent too much time with it, so maybe one of you two can discuss on that. But I think one example would be Keep Network, which has a very active work token, which we've invested in. We will be running computation and securing keeps within that network quite actively, and using our keep tokens within that. So that's sort of our position, but it's not quite as active as Augur, I'd say.
I'm an engineer by background. We have a full-time engineer on staff at CoinFund today. We're going to build those things in-house.
The only thing I'd add in the case of Augur is, to answer your question, is just yes. We are long Augur. We watch the markets and we participate, but it's not that big of a time commitment, and we can just have analysts do it. It's not a big deal.
Cool. I'm gonna end on this.
Yeah, I'm going to end on that. Thank you guys very much. That was really fun.